Hit, crashed. Silver drops 8 to 8%. The liquidity crunch is here, 8%. In a single session, silver didn't just fall, it collapsed. But here's what they're not telling you. This wasn't about silver at all. When JP Morgan started moving billions out of overnight markets, when the repo rates spiked without warning, when central banks went silent, the smartest money on Wall Street knew something. They saw what's coming. And silver? Silver was just the first domino. The liquidity crunch isn't approaching anymore. It's already here. And what happens in the next 72 hours will determine who survives and who doesn't. Welcome to Financial Inspection. You know, my friend, in times like these, when the financial ground beneath us starts shifting, having the right information isn't just valuable, it's survival. If you've been around long enough to see a few market cycles, to remember when a handshake meant something, when trust was currency, then you understand why we're here. This channel exists for people who take their financial decisions seriously. So if you haven't already, I'd like to ask you to subscribe, not for us, but for yourself. Because what we're about to walk through together requires commitment, attention, and follow through. And one more thing, drop a comment below and tell us, where are you watching this from today? Are you in New York, watching the markets from your office, London, seeing the overnight numbers come in? Dubai, Singapore, Mumbai? Let us know. Because this liquidity crunch, it doesn't recognize borders. Now, let's get into what's really happening. On the morning of the crash, traders in New York opened their screens to something they hadn't expected. Silver, the metal that industrial manufacturers depend on, the asset that investors hold as insurance, was down 8%. Not over a week, not over a month. In hours. 8% doesn't sound catastrophic until someone understands what it means. For a commodity market that moves in fractions, that trades on thin margins, an 8% drop in a single session is violence. It's forced selling. It's panic. But the analysts who understand market structure, the ones who've seen crises unfold before, they weren't looking at silver itself. They were looking at what silver was telling them. Because silver wasn't crashing because of supply problems. There was no sudden discovery of massive new mines. There was no collapse in industrial demand. The fundamentals hadn't changed overnight. Silver was crashing because someone, somewhere, needed cash. Fast. This is how liquidity crises announce themselves, not with press releases, not with official warnings from central banks. They announce themselves through strange price movements in assets that shouldn't be moving that way. When investment funds hold silver, they hold it as a stable store of value. When they suddenly dump it at any price, when they're willing to take an 8% loss just to get out, it means they need liquidity more than they need the asset. And that's the signal. The professionals who manage billions, the risk managers at major banks, the Treasury officials monitoring financial stability, they saw that signal clearly. A liquidity crunch doesn't start with headlines. It starts with tremors. Small cracks that appear in places most people aren't watching. 3 weeks before silver crashed, something unusual happened in the repo market. This is the market where banks lend to each other overnight. It's supposed to be boring. It's supposed to be stable. The interest rates there barely move, except they did move. Repo rates spiked. Banks that usually lend to each other freely suddenly wanted higher rates. They wanted more collateral. They were holding back. That's fear. Then there were the Treasury markets. U.S. government bonds, the safest, most liquid assets in the world, started showing weird price gaps. Spreads widened between buying and selling prices. Trading volumes dropped. When the most liquid market in the world starts showing signs of stress, when dealers step back, when bid-ask spreads widen, the professionals know what that means. It means the system is getting tight. Banks started reporting higher cash reserve levels. On the surface, that sounds good. Banks holding more cash should mean they're safer. But experienced analysts asked a different question. Why are they holding cash instead of lending it? Because when banks hoard cash, when they pull back from their normal lending activities, when they start preparing for something, it means they see risk. They see trouble coming. And then silver crashed. This is the pattern. This is how it always starts. In 2008, it started with weird movements in mortgage-backed securities. In 1998, it started with emerging market debt. In 1987, it started with portfolio insurance strategies breaking down. The asset class changes. The trigger changes. But the underlying dynamic is always the same. Somewhere in the system, leverage becomes too high. Somewhere, borrowed money funds too many positions. And when the first margin call comes, when the first fund needs to sell, others follow. Because in modern finance, everything is connected. One fund's selling becomes another fund's loss. That loss triggers another margin call. That margin call forces more selling. It cascades. The silver crash wasn't an isolated event. It was a symptom of something deeper. It was the market's way of saying the liquidity that everyone assumed would always be there isn't there anymore. Business leaders who understand this, who've been through market cycles before, they recognize the pattern. They've seen this movie before. They know that what starts in commodity markets doesn't stay in commodity markets. They know that what begins as a technical problem in silver or repo markets eventually becomes a practical problem for every business that needs to borrow money, refinance debt, access credit lines, or simply meet payroll during a cash flow gap. The warning has been given. The question now is what comes next, and who's prepared for it. The executive sat in his corner office, staring at a number on his screen that didn't make sense. His company's credit line, the one they had had for 15 years, the one they barely used but kept as insurance, had just been reduced. No warning, no negotiation, just a notification from the bank. He called his CFO. She'd received the same message. Their backup lender, the second credit facility they maintained, had tightened its terms. Higher rates, more collateral required, shorter maturity. "What's happening?" he asked. She didn't have an answer yet. But across the city, across the country, across the global financial system, thousands of other executives were asking the same question. What's happening is the machine is seizing up. Most people think of markets as simple. Buyers and sellers meeting, exchanging assets for money, clean, direct, simple. That's not how modern finance actually works. The real system is a massive web of promises. Promises to pay, promises to deliver, promises to lend. And all those promises depend on one critical assumption, that liquidity, the ability to convert assets into cash quickly, will always be there when needed. Except now it isn't. Here's what most business owners don't see. When they look at their bank account and see a balance, they think that money is sitting there waiting. It's not. That money is out in the system, lent to someone else, who lent it to someone else, who used it as collateral for something else. The entire financial system runs on velocity. Money moving, credit flowing, assets being pledged and repledged. When that velocity slows, when people start holding instead of lending, when banks start demanding their money back instead of rolling over loans, the machine begins to jam. This is what a liquidity crunch actually means. It starts in the places nobody watches. The commercial paper market, where corporations borrow for short periods to cover operational expenses. Suddenly, investors who always bought that paper start stepping back. They want higher yields, they want shorter maturities, or they don't want to buy at all. A corporation that's been rolling over its commercial paper for years, funding its payroll, its inventory, its daily operations, suddenly can't sell new paper, or can only sell it at rates that don't make sense. That corporation now has a problem. Then there's the overnight lending market, banks that lend to each other every single night to balance their books. It's mechanical, it's routine, it's been happening smoothly for decades. Until it doesn't, interest rates spike. Banks that usually lend freely start rationing. They're not refusing because they're being difficult. They're refusing because they're scared. They don't know who else is in trouble. They don't know which counterparty might not be able to pay back tomorrow. So they hold their cash. And when banks hold cash instead of lending it, when money market funds become selective, when corporate treasurers can't access the credit they've always had, the crunch spreads. Margin calls accelerate everything. An investment fund holds a portfolio of assets. Those assets are pledged as collateral for borrowed money. When asset prices fall, like silver falling 8%, the collateral is suddenly worth less. The lender makes a margin call. Put up more collateral or we sell your positions. The fund doesn't have more collateral, so positions get sold. Those sales push prices lower. Lower prices trigger more margin calls at other funds. More forced selling. More price drops. It feeds on itself. Credit spreads tell the story clearly. The difference between what the US government pays to borrow and what corporations pay, that gap is widening. Not slowly, rapidly. Corporate bonds that traded smoothly last month now have buyers demanding significantly higher yields. That's not because the companies got worse. It's because liquidity is disappearing. Investors want to be paid more to tie up their money in anything that's not immediately convertible to cash. Currency markets show the same stress. The US dollar is strengthening, not because the American economy is thriving, but because everyone globally needs dollars to pay dollar-denominated debts. And dollars are getting harder to find. Foreign corporations that borrowed in dollars when rates were low, they're now scrambling to find dollars to make payments. They're selling assets. They're tapping emergency credit lines. They're doing whatever it takes. This is the mechanical reality behind the headlines. For the business owner, the entrepreneur, the corporate executive, this translates into something very concrete. That credit line being reduced isn't personal. That bank isn't targeting their company specifically. The bank is reducing exposure everywhere because the bank itself is facing pressure. The supplier who always offered 60-day payment terms now wants payment in 30 days, or 15, or upfront. The customer who always paid on time is suddenly asking for extended terms because they're facing their own cash squeeze. Working capital, the lifeblood of operations, starts evaporating. And here's the dangerous part. This happens faster than people expect. From the first signs of stress to full crisis, the timeline can be weeks, sometimes days, because once the crunch starts, once confidence breaks, once everyone simultaneously tries to grab cash and reduce risk, the system can't handle it. There isn't enough liquidity to go around. That's not a prediction. That's what's happening right now. The phone rang at 2 a.m. The private equity partner answered, already knowing it wouldn't be good news. His firm had spent the last decade building a portfolio of leveraged acquisitions. Solid companies, good cash flow, well-structured deals, or so he thought. The voice on the other end belonged to his lead banker. We need to talk about the refinancing. 3 words that change everything. Need to talk. Not we're moving forward. Not terms are ready. Need to talk. The refinancing that was supposed to be routine, the debt rollover they'd done a dozen times before, was now uncertain. The bank wanted new terms, higher rates, more equity, shorter duration, personal guarantees. He hung up and stared at the ceiling. His firm wasn't special. Across the financial landscape, from New York to London to Singapore, similar conversations were happening. Similar realizations were dawning. The liquidity crunch doesn't hit everyone equally. It hunts for weakness. It finds leverage. It exploits dependency. And right now, it's moving through the system like a predator, selecting targets. Real estate sits at the top of the vulnerability list, not because buildings stopped having value, not because tenants disappeared overnight, but because of how the deals were structured. A developer bought a property 3 years ago, 70% debt, 30% equity. The loan was short-term, meant to be refinanced after the property was improved and leased up. The property performed. Occupancy increased. Rents grew. Everything went according to plan. Except the refinancing market. When that loan comes due and the developer goes to refinance, the lenders who were eager 3 years ago are now cautious. They're offering 60% debt instead of 70%. They want higher rates. They want more reserves. The math breaks. To close the gap, the developer needs to inject more equity. But their equity is already tied up in other projects. They need to sell something, or find a partner, or default. Multiply that scenario across thousands of properties, across office buildings, shopping centers, apartment complexes, and the picture becomes clear. Real estate isn't collapsing because of fundamentals. It's collapsing because of financing. Private equity faces the same equation with different assets. These firms build empires on leverage. Buy a company with 20% equity and 80% debt. Improve operations. Sell for a profit. Repeat. That model works beautifully when debt is cheap and available. But when credit markets tighten, when lenders pull back, when refinancing becomes difficult or impossible, those portfolio companies face a choice: sell assets to raise cash, cut costs dramatically, or restructure debt at painful terms. The firm that looked brilliant during the easy money years suddenly looks exposed. Technology companies with high burn rates are discovering their own vulnerability. The startup that raised money 18 months ago, that was told to focus on growth, not profitability, that spent freely on expansion, now faces a different reality. The next funding round isn't coming, or it's coming at a valuation that wipes out earlier investors. The venture capital firms that backed them are telling their portfolio companies the same thing. Cut your burn rate by 50%. Get to profitability. Survive. Some will make it, many won't. The companies that can't cut fast enough, that run out of cash before they reach profitability, they'll close. Not because their product was bad, not because their team was weak. Because the money ran out and no one would write another check. Small and medium-sized businesses face perhaps the most immediate danger. They don't have backup credit lines with multiple banks. They don't have access to capital markets. They don't have treasury departments managing sophisticated hedging strategies. They have a local bank relationship, a line of credit, maybe some supplier financing. When that bank gets cautious, when that credit line gets reduced, when suppliers demand faster payment, these businesses have limited options. The manufacturer with 60 days of cash on hand, who always relied on their credit line for seasonal fluctuations, suddenly can't access that line, or can only access half of it. One bad month becomes an existential crisis. Export-oriented businesses are caught in a double trap. Not only are they facing the same credit tightening as everyone else, they're also dealing with currency volatility. The strong dollar makes their products more expensive to foreign buyers. Orders slow, revenue drops. At the same time, if they borrowed in dollars to fund operations, those debts just became more expensive in local currency terms. Less revenue, higher debt costs, tighter credit. The walls close in quickly. Emerging markets amplify every problem. A corporation in Brazil or Turkey or South Africa that borrowed dollars during the cheap money years, they're now facing a nightmare scenario. The dollar is strengthening. Their local currency is weakening. Their dollar debts are ballooning in local terms. They need dollars to service that debt. But dollars are scarce. And getting scarcer, they sell assets at distressed prices. They lay off workers. They cancel expansion plans. They do whatever it takes to find dollars. Some won't find enough. History provides the template for what happens next. In 2008, Lehman Brothers failed not because it ran out of assets, but because it ran out of liquidity. It couldn't roll over its short-term debt. When confidence disappeared, so did access to funding. In 1998, long-term capital management nearly brought down the financial system, not because its investments were worthless, but because it couldn't meet margin calls. Leverage plus liquidity crunch equals disaster. The pattern repeats because the mechanism is always the same. High leverage plus disappearing liquidity equals forced selling equals lower prices equals more forced selling. The executives who recognize their exposure now, who see themselves in these scenarios, they have time to act. The ones who assume it won't happen to them, who believe their situation is different, who wait for clarity before moving, they're the ones who won't survive what's coming. The CEO made a decision that surprised his entire management team. In the middle of a Tuesday afternoon, with no immediate crisis visible, he instructed his CFO to draw down their entire credit line. All of it, every available dollar. The CFO hesitated. "We don't need the cash right now, and it'll cost us interest on money we're not using." The CEO's response was simple. "Draw it. Today." By Friday, 3 of their competitors tried to access their credit lines. 2 found their banks had reduced the available amounts. 1 found their line suspended entirely pending review. The CEO who acted on Tuesday had cash. The ones who waited did not. This is what preparation looks like when a liquidity crunch is underway. Not panic, not guessing. Strategic action based on understanding what's coming. Cash becomes the first priority. Not profit, not growth, not market share. Cash. Because when liquidity disappears, when credit lines vanish, when payment terms tighten, the only thing that matters is having money in the bank that can't be taken away. Smart operators are making immediate moves. They're reviewing every dollar of working capital. Inventory that's sitting idle gets sold, even at a discount. Accounts receivable get collected aggressively. Payment terms with customers get shortened. Every source of cash gets maximized. One manufacturing firm sent a quiet message to their top 50 customers. Pay your invoices within 15 days instead of 30 and receive a 2% discount. 43 customers took the deal. The firm pulled forward millions in cash flow. That's strategic thinking. Credit lines require careful calculation right now. Some businesses should draw them fully, immediately, while they still can. Lock in access to cash before the bank changes its mind. Others should protect the optionality. If drawing the line triggers covenants or accelerates other obligations, sometimes it's smarter to leave it untouched but ready. But here's what no one should do. Assume the line will be there when needed. Banks are pulling back. Not because they're evil, because they're scared. They're managing their own risk. They're reducing exposure everywhere. The credit line that exists today might not exist next week. The executive who understands this acts accordingly. Debt maturities demand immediate attention. Any debt coming due in the next 12 months needs to be addressed now, not in 6 months, not when it's convenient, now. Can it be refinanced? At what terms? If terms are worse than expected, is it still better to lock them in than to wait and hope? Some firms are discovering painful answers. The debt they could have refinanced 3 months ago at reasonable terms now comes with conditions they don't like. Higher rates, more restrictions, less flexibility. But they're taking those terms because 3 months from now, the debt might not be refinanceable at all. Others are selling assets to pay down debt entirely. Taking the leverage off the table, reducing the vulnerability. It feels defensive. It feels like retreat, but it's survival. Operational adjustments separate the prepared from the exposed. Inventory strategies shift. Instead of optimizing for efficiency, firms start optimizing for flexibility, less just in time, more buffer stock for critical items. Because supply chain disruptions plus credit tightening is a combination that can shut down operations, one automotive parts supplier made a calculated decision. Buy 6 months of raw materials now, even though it ties up cash, because they can't risk their suppliers cutting them off if credit tightens further. Expensive? Yes. Necessary? Absolutely. Relationships with suppliers and customers become critical negotiation points. The firm that's been a reliable customer for years, that always paid on time, they have leverage now. They can negotiate. They can ask for extended terms or flexibility, and good suppliers will accommodate because they value the relationship. The firm that was always late, always negotiating, always pushing boundaries, they're getting cut off. Suppliers are reducing credit, demanding cash up front, prioritizing better customers. Past behavior determines present options. Capital expenditure plans get ruthlessly prioritized. Projects that aren't essential, that don't generate immediate cash, they get postponed, deferred, canceled. One tech company was planning a new headquarters. Beautiful building. Great for morale and recruiting. They canceled it, kept the existing space. Redirected that capital to building cash reserves and paying down debt. Painful decision, right decision. Defensive positioning means knowing exactly who you're exposed to, which customers might not pay, which suppliers might fail, which banks might pull back. A construction firm did a quiet analysis of their top 20 customers. They ranked them by financial strength. The bottom 5, the ones showing stress, got moved to cash before delivery terms. 2 of those customers complained, 3 accepted it. Within 60 days, one of the customers who complained filed for bankruptcy. The construction firm had no receivables exposure. Their competitor, still waiting for payment, lost everything. Risk management isn't abstract right now. It's concrete and immediate. But here's where it gets interesting. Liquidity crunches destroy some businesses. They create extraordinary opportunities for others. The firms with cash, with access to credit, with strong balance sheets, they're in a position to acquire assets at discounts that won't be available in normal markets. Distressed sellers need liquidity. They'll accept lower prices. They'll negotiate favorable terms. They'll do deals they wouldn't consider 6 months ago. One private equity firm has been raising a distressed opportunities fund. Not someday, right now, because they know what's coming. When forced sellers meet prepared buyers, wealth transfers. Strategic partnerships become more valuable than competition. Firms that might have been rivals start talking about consolidation, about merging, about combining balance sheets to survive what neither could survive alone. The strong acquire the weak. The prepared absorb the unprepared. This isn't cruelty. It's how markets work when liquidity disappears. Long-term preparation means redesigning business models for a different environment. The era of cheap capital is over, maybe for years, maybe for a decade. Businesses built on the assumption of low rates and easy refinancing, they need to restructure, reduce leverage, increase margins, build in buffers. The cost of capital is higher now. Business models need to generate returns that justify that higher cost. Companies that adapt survive. Companies that wait for the old world to return don't. Scenario planning becomes essential. What if credit stays tight for 18 months? What if it gets worse? What if key customers fail? What if suppliers demand cash? The executive team that's running these scenarios, stress testing their assumptions, building contingency plans, they're the ones who will navigate successfully. The silver crash was the warning shot. The liquidity crunch is here. What happens next depends entirely on who prepared and who didn't. The executives reading this right now have a choice. Act on what they know, or wait for certainty that will never come, because by the time everyone sees it clearly, by the time the crisis is obvious to all, the time to prepare will have passed. The smart money is already moving. The question is whether you're moving with them, or whether you'll be the liquidity they're extracting from the system.